Candlestick patterns explained. How to read the story behind every candle, every single chart you open, whether you're looking at Apple, the S&P 500 or Bitcoin, is made up of these little boxes and lines. Most beginners glance at them, notice the colors, and move on. But here's what they're missing. Each one of those candles is telling you a story. It's showing you exactly what buyers and sellers did during that time period. And when two or three of them form a specific pattern, they can tell you whether momentum is building or falling apart. By the end of this video, you'll be able to look at any candlestick chart and recognize 4 of the most important patterns, what each one means, when traders pay attention to them, and the one mistake that causes beginners to misread them every time. Let's start with the basics. Before we get to patterns, you need to understand what a single candlestick is actually showing you. Each candle represents one time period. On a daily chart, that's one trading day. The body of the candle shows you where the price opened and where it closed. If the close is higher than the open, the body is green. Buyers were in control. If the close is lower than the open, the body is red. Sellers pushed price down. The thin lines sticking out of the top and bottom are called wicks, or shadows. The upper wick shows how high price moved during that period before pulling back. The lower wick shows how low price dropped before recovering. Long wicks tell you there was a fight. Price tested those levels, but one side won. So a candle with a large green body and tiny wicks means buyers dominated from open to close, almost no contest. A candle with a tiny body and massive wicks means price whipped in both directions but ended up almost where it started, indecision or a battle between buyers and sellers that nobody clearly won. That's the foundation. Now let's look at what happens when candles form specific shapes and patterns. There are dozens of candlestick patterns traders track, but 4 show up repeatedly and are worth every beginner learning. A doji is a candle where the open and close are almost exactly the same price. The body is basically a flat line with wicks above and below. This happens when buyers and sellers fought to a draw. Neither side took control. On its own, a doji is a signal of indecision. The current trend may be losing steam. The key is context. A doji after a long uptrend carries more weight than a doji in the middle of a sideways range. When traders see a doji at a potential peak, they start watching to see which direction the next candle breaks. A hammer has a small body at the top of the candle and a long lower wick, typically at least twice the length of the body. It looks like, well, a hammer. This forms when price dropped sharply during the session, but buyers stepped in and pushed price back up near the open by the close. The shooting star is the opposite of the hammer. Small body at the bottom, long upper wick. Price rallied sharply during the session, but sellers pushed it back down near where it opened. The long upper wick shows buyers tried to push higher, but sellers rejected that move. After an uptrend, a shooting star is a sign that buying pressure may be fading. This is a 2-candle pattern. A bullish engulfing happens when a large green candle completely covers or engulfs the prior red candle. The new candle's body is bigger than the previous one. Buyers came in strong enough to erase the prior day's selling and then some. These 4 patterns, doji, hammer, shooting star, engulfing, appear on every chart and form the foundation of candlestick analysis. Knowing what these patterns look like is step 1. The more important skill is reading them in context, because a pattern without context is just a shape. Here's the framework traders use. Candlestick reversal patterns only matter if there's a trend to reverse. A hammer is meaningful after a downtrend. If price has been moving sideways for 3 weeks, a hammer is background noise, not a signal. In this chart, you can see a multi-week decline ending in a hammer pattern. The long lower wick shows sellers pushed hard but couldn't hold it. Buyers stepped in at a meaningful level. The next several sessions showed price reversing higher. That's a hammer doing exactly what traders read it to mean, exhaustion of selling pressure. Reversal patterns become much more significant when the next candle confirms the move. A hammer that's followed by a green candle closing higher than the hammer's high gives traders a confirmation signal. A hammer that's immediately followed by another big red candle tells you sellers are still in control. The pattern failed. This is where many beginners trip up. They act on the pattern before seeing the follow-through. Professional traders wait for confirmation. When a hammer or engulfing candle forms on above-average volume, it carries more weight. Heavy volume means more market participants saw that level and acted. It's the difference between a signal that represents institutional buying and one that represents thin, low-conviction trading. A high-volume bullish engulfing after a downtrend, followed by a confirming green candle, is one of the strongest basic reversal signals in candlestick analysis. Not a guarantee, nothing in technical analysis is, but a meaningful shift in the weight of evidence. Even with 4 solid patterns in hand, there are 3 mistakes beginners make repeatedly. Candlestick patterns are probability tools, not predictions. A shooting star at a peak is a warning sign. It shifts the odds slightly toward a pullback. It doesn't mean sell now. Traders use patterns alongside other evidence: trend direction, support and resistance levels, volume, and sometimes a second indicator like RSI or moving averages. A pattern alone is not a trading plan. The shorter the time frame, the noisier the patterns. A doji on a 5-minute chart is largely meaningless. A doji on a weekly chart near a major resistance level is something traders pay close attention to. For beginners, start with daily charts. They provide enough data without the noise of intraday movement. A bullish engulfing candle in the middle of a long downtrend is a blip, not a reversal. Candlestick patterns identify short-term momentum shifts. If the larger trend is strongly against you, those shifts tend to fail. Always read the candle in context of what the chart has been doing over the prior weeks and months, not just the past 2 days. Let's bring it together. 3 things to take from this video. First, every candlestick shows you where price opened, where it closed, and how far it traveled in both directions. The body tells you who won, the wicks tell you who tried. Second, the 4 patterns to know are the doji, the hammer, the shooting star, and the engulfing candle. Each one signals a potential shift in buyer-seller balance, and everyone needs context and confirmation before you act on it. Third, patterns fail when beginners use them alone. Trend direction, volume, and the follow-through candle are what separate meaningful signals from noise. Now, which candlestick pattern do you actually see on your charts most often? Drop it in the comments. I read every one, and it helps me decide which topics to cover next. If this video helped you understand charts a little better, subscribe. There's a full series on technical analysis indicators right here on the channel. This video is for educational purposes only and is not investment advice.